Thank you very much, Professor. Let me introduce myself. My name is Matt Cooper. I am a broadcaster and journalist here in Ireland. Some of you Irish members of the conference may know me. To the rest of you, let me just say that I do have a certain background in business journalism originally, but I would not try to pretend to be any expert on insurance. And I, in some respects, I'm going to be here in the next part of the session, acting in the role of the customer or the consumer, asking questions of those of you who are actually experts. Now, as you know, we had 4 parallel sessions this morning, and I chaired one of those sessions, and I will be reporting back on it in a moment. But I'd like to ask the other 3 moderators of those parallel sessions to join us on the stage to give us reports. So could we please welcome back Professor Karel Van Hulle, Torbjörn Magnusson, and Governor Dirk Kempthorne. Thank you. If the 3 of you could join us. So I think it's fair to say that the 4 sessions this morning, and I know they were very well attended, the various sessions, that they are in many ways interlinked, because having had a conversation with the 3 gentlemen here about what was done, I could see parallels emerging very, very quickly. But I'm going to ask each of them, just while seated, to take us through what was actually said at their particular session. So, Karel, if you would like to perhaps just outline what was discussed and what your main conclusions from your parallel session, which dealt with the global economic shift and global markets was.
Yeah, we had a very interesting panel with a representative of the microinsurance network, the World Bank, but also an insurer who is engaging in some of these markets. And the first conclusion that was made is that you can divide the world in a global north and a global south. And of course, the global south is searching for solutions. But what is important is that these markets are not homogeneous. And also that microinsurance is not a target market for every insurance product. A second conclusion that was made is that if you want to engage in a market, what is important is to have a strong local presence and to be able to rely on strong local partners. What is also important is that you give the feeling to the people that you're playing a long game. You're not there just to in and out. And what is very important also that you try to be ahead of regulation in terms of market conduct, consumer protection. If you have that good reputation, the likelihood that you will succeed in the market increases. There are tremendous differences between markets. Sometimes there are regional groupings that you can make, and markets can learn from each other, and therefore it's very important to learn from comparative data. There is a need for a good regulatory basis and for enforcement. And one can always encounter fraud. And the example was given of insurance of camels and cows, where suddenly a lot of ears appeared on the market because people wanted to collect on their insurance. And the beasts were still alive, of course. Messages that were made, going on what we had just heard, is how important it is to educate the consumer and to sell simple products, to have the right regulatory infrastructure. And also, very importantly, there's a lot of expertise available at the World Bank and at the microinsurance network, where you can learn if you want to engage these markets. And the last thing that was mentioned was that if you want to move into an area like health insurance, you may want to rely on pocket doctors, which to me sound like robot advisors. So that was the virtual world in which you probably are going to enter very soon. So that's basically some of the messages that came out of my session.
Thank you very much for that. Now, I'm just going to briefly, I had left my phone up here. Did I tell everyone to please put their phones to silent? Because I'm just very worried that mine might just go off as I had left it there with the timer on to see where we're going. We're going to move now to technological advances and the distribution channels, which was one of the other parallel sessions. So, Torbjörn Magnusson, could you please give us a brief synopsis of what took place at that session, please?
Sure, I'll be pleased to. And we had quite a lively session, I think, around this theme. Where 3 underlying themes came out in all the presentations. One is that technology is probably more important than ever for the insurance industry, as it now affects all sides, all parts of our operations in a way that we haven't seen, at least in many, many years. This is quite demanding at the same time as it's very, very exciting and creates new distribution channels and new distribution possibilities. Secondly, we spoke about customer design power. We are used to a world where we can prescribe to the customer how they interact with us, what the products look like. But on the web and then in the new world, we have to adapt to the customer. If it's not convenient to them, they go elsewhere. And they can do that very rapidly. And thirdly, there was a discussion around the whole question of omni-channel distribution. Customer interaction with us has to be rethought entirely in this context. Walter Trevisani from Generali spoke about 3 practical emerging examples of these things, very fascinating applications emerging. One is relatively well known, telematics, where there are now millions of customers around the world. Pricing, loss prevention, but also exclusion of individuals based on this was discussed. Then the second example, the connected home, is around the corner and has started to be real. And the same themes, pricing, loss prevention, and excluding people from the data that brings. And thirdly, yet to be seen full scale, and I'm inventing a new word for this. I'm sorry for that, Walter, but the connected body, a health program for individuals. And then the third participant in our panel is Cecile Wendling from AXA, with insights of future concepts of distribution and really exciting examples from around the world of insurance being bought by voluntary affinity groups, obtaining value for money cover for their participants, and policies embedded in other types of purchases, telephones, air tickets, car purchasing. So a whole range of different new concepts arising out of technology developments and a lively discussion, and I think we left feeling that we're living on the verge of a new world and a wave of change.
Thank you, and I'm going to be back to many of those items because they do very closely correlate with the panel discussion that we had on serving the customer better. But before I give you my report back on that particular session, I'm going to ask instead for our next session for Governor Dirk Kempthorne to tell us about global and European stability and policy and regulatory implications, please.
Matt, thanks very much. Kevin, I began the program that had Julie McPeak, the Vice President of the National Association of Insurance Commissioners, and Steve Ryan, the Deputy Head of the European Commission, by referencing the beautiful event you had for us last night that Insurance Ireland did at Guinness. All of the science that was there, the chemistry of creating that liquid. But the point was, in this scientific world that we all live in with actuarial tables, I met Frank Farrell last night and had a wonderful conversation. And he brought the humanity into the whole thing, that he is one of 9 children. His father worked at Guinness. So the Guinness wage provided for 9 kids. After World War I, they were able to get a home that had been built by the military. They bought it for 550 crowns. That his sister, when she turned 60, was diagnosed as being low on iron, and it was prescribed by her doctor that she needed to drink 1 pint of Guinness per day. She did so and lived another 28 years. That the Guinness employees were given dentistry, medical health, pensions. It was a very good world. And yet we think of the world now that has changed from the pensions to defined benefits. And so it just, again, it brought the humanity, and I had more comments after the panel about the reality. We must not forget why we are all in this business. It's for the families like the Farrells that want to have a future. In this discussion, we talked about Solvency II. Of course, we know that it is underway, but it was pointed out that in 2018, there'll be a reevaluation of how is Solvency II going, and then they will deem if there are any changes that should be made to Solvency II at that point. Then how does ICS fit into this? Well, it was pointed out that targets are in place with regard to ICS. The questions of valuation are still being discussed, but that significantly, that reevaluation of Solvency II in 2018 will be important on the final decisions with regard to ICS. We talked about also systemic risk. We discussed what is systemic risk. How is it you choose one or two companies, whereas the IMF has suggested maybe it's an entire industry that may be systemically at risk. But Commissioner McPeak made the point that the focus from NAIC is on consumer protection, that should be the focus, and that gets to avoiding systemic risk. They indicated that they were worried about going too far with regard to, for example, capital, because the industry needs to make long-term guarantees for longevity and to allow for investing in those long-term investments, such as infrastructure, which is critically important throughout the world because of the gap in infrastructure. That also they are mindful that by these long-term investments, it also serves as a counter-cyclical balance, as a buffer with regard to other financial services. We also discussed Governor Tarullo's comments that were made last week at the National Association of Insurance Commissioners, and that the response from both individuals on the panel was that it was very positively received. And as Steve Ryan said, it showed great progress. The Fed is now fully engaged with regard to this issue of regulation, with regard to the systemically important financial institutions, and then, of course, what that implication may be globally. It was also then stated that longevity, we talked about longevity, the fact that you guarantee for those who want to have dignity for their entire life, but that this new thing of longevity, quantity of life, does not necessarily equate to quality of life. And how do you square this? And as we discussed that, it was acknowledged that there is a retirement crisis that is there on the horizon. And how do we deal with that? How do we deal with that crisis? The European Commission is exploring innovative products, such as the Pan-European Pension Product, to create consistent products throughout Europe, which we thought was extremely important. The conclusion of this was that Julie McPeak, who referenced the president of the NAIC, John Huff, having stated last week that a rising tide of global best practices benefits all without regard to size or market. So again, it was a very good discussion, Matt, and it's one that probably could have gone on for at least another hour, but very good dialogue from all that were participating.
Thank you, Dirk. I'm very taken with your story of the Farrells. Iron deficiency, unfortunately, is a very common affliction in Ireland, and many people have had to drink Guinness over the years for medicinal purposes as a result. Okay, the session that I moderated was in relation to the customer in tomorrow's world. We had 3 speakers on it. We had a representative for the Central Bank of Ireland, Director of Consumer Protection, Bernard Sheridan. We had the Chief Executive of Liberty Insurance in Ireland, giving us the general insurance perspective, the Deputy Chief Executive of CMP Assurances in France, looking at the life assurance sector. But there was consensus that communication with consumers is a key issue. And here's something for you all to ponder. It was said, and there was no disagreement, that bankers are actually better at communications with their customers than the insurance industry may be. Now, that can be down to difficulty explaining products, and the benefits arising from having insurance is not always necessarily clear to consumers. It was very much emphasized that insurance is a long-term business, a long-term customer relationship, that if you lose a customer, it can take 5 years longer to get that customer back if you can get that customer back. We had a big discussion about digitalization. We felt that the products been offered by digitalization need to be really simple and straightforward. It was said 4 clicks maximum to make a transaction. But yet, not everything can be digitalized. There's a need for empathy and for understanding from direct human contact, be that face-to-face or be it on the phone. And it meant that there has to be, well, an integrated journey in the sales process, the use of social media, multiple channels. But the irony of all of that is that while all of these things, the proliferation of different methods is becoming widespread and common, there is a demand from the consumer for greater personalization. So that's quite a challenge for the industry to face. But the use of big data was also mentioned, and the issue of trust was a major one here. People have to trust that their data is being used to the benefit of consumers and not to the provider. And that led on to a discussion as well about pricing and risk and how that can be adjusted by the greater amount of information that is available now because of big data. Don't just rely on the price, though, is something that was also emphasized. Competition on the basis of price is not necessarily the best for insurers. It has to be on the elements of the product, what is covered and what is excluded. We also had a discussion about the low interest rate environment. Again, the competition on price killing the industry came up as a major issue there. We also discussed for consumers the promises that have to be kept and the expectations that they will be kept. And again, the role of the regulators in that regard was examined as well. We looked, and this gets back to the digitalization, about the role of intermediaries, because consumers do value advice. We discussed the role of humans against robots, the remuneration of intermediaries, the automation of advice might be a risk for consumers. It might be a risk as well for companies who depend on it rather than providing humans to give the information. We spoke about good regulators and good regulation, trying to examine the tension and dynamic that there should be between the industry and the regulators. And it was stated, if a company does things correctly, then that tension will be diminished. But it cannot be a cozy relationship necessarily either. We said that the insurance industry is very well regulated at a European level, for prudential, for operational level, but it cannot be allowed, that level of excellence and regulation cannot be allowed to become a handicap against international competition. And we concluded on perhaps a somewhat controversial note, the role of the European Court of Justice and a particular case in relation to insurance for female drivers and individual premiums based on gender. So we have a situation where we have big data and we have greater information about specific individuals and as to how they should be priced for their insurance, and instead what we've received is, on the basis of the European Court of Justice and perhaps bigger societal norms rather than insurance needs, we have premiums based on gender. Okay, that's a summary of what we dealt with in our particular discussion. And I'm going to go back to Torbjörn, because a lot of what you discussed in relation to technological advances and distribution channels, I think, overlapped particularly with what we did in our discussion in relation to consumers. I'm very interested in what you say about the customer prescribing the look of the product, because how is that going to tally with what I've just reported back from our particular session there about perhaps the customers, yes, wanting things provided for them digitally, but perhaps not understanding what they get?
I think much of what you said about your session is really interesting and fascinating. Insurance products are a wide range of products, aren't they? Some of the products people think that they understand fairly well, even if it's an insurance contract, car insurance being one of them, for instance. Car insurance is also a product that you buy reasonably often, and customers expect to be able to go onto the web maybe and just fill in the registration number and some personal data and then get a price. And they want to do this very conveniently, otherwise they're going to leave the site and go somewhere else. Maybe chat a little bit online with somebody if they have a question about something simple like the deductible. The other end of that spectrum, of course, are various savings products, where I think for forever probably there will be a need for more more detailed advice, and we will never leave that. But part of that data can, of course, be supplied online. So there are very big differences between different products, even if they are labeled insurance, all of them.
But the difficulty would appear to be in personalizing them for people. Even if the technology is available, how do you personalize those various offerings?
Well, I think that the digitalization in many cases offer more opportunities to personalization, individualization than what we have today in our systems. Of course, I jokingly maybe have said on a number of occasions that digitalization is really attractive from the customer point of view. They get much more flexibility from the companies. They get the opportunity to influence their covers in various ways, whilst it's the opposite really for the companies that have to implement this on the back side of various computer systems and the web. So it is a big demand on the insurance industry to meet this natural inclination that arises out of the internet context, isn't it? You're getting used to personalization from using the internet in so many contexts.
Well, let's just throw this open to the others as well and what your views on this be, because for the insurance industry, is the increasing availability of new technology been viewed as a way of improving the service to customers, or has it been taken as a way of reducing the costs of supply? Karel?
Well, my fear is that it's the last one. I think that it's very important for the industry to keep underlying that what you're doing is not selling a product, but a service. And it's nice to buy a cheap insurance product with 4 clicks. I'm very worried about these clicks, because you're really going to have the wrong click, I tell you. And the fifth one that isn't asked to you, that was the decisive one. You see, that's the problem. The problem is that people buy motor insurance, no problem with 4 clicks, until they get an accident. And they try to get in touch with the insurer to get compensation. The thing doesn't work, because the product was designed such that it works with 4 clicks, you see. And I think that is the danger with digitalization, that we lose the focus on the client, on the service to the customer. And that is really something that the insurance industry, in my experience, need to spend more on, is in terms of trying to deal with the fact that people are naturally risk averse. They will not cover themselves unless they get somebody to tell them. And that's why it is so important to keep that advice. And that is my worry with digitalization, which we won't stop, by the way.
Yeah, but hold on, digital natives. In fact, when I heard about the 4 clicks this morning, I was thinking, that sounds like quite a lot for the modern generation. They want to be able to do it a lot faster than that. You look askance at me.
Well, I tell you, any website where I make 4 clicks, I know for sure that I need 6 clicks to make sure that the last click is the right one. That's the problem, you see. People try to create robots, robots or virtual people. But it is about people, what Peter Maas was saying. We move away from products to the people, oriented to my specific situation. And maybe you are happy with 4 clicks. Maybe I need 10 clicks because I'm more stupid than you are, Do
you want to come back into that? Yes.
I just thought that this is going to sound very paternalistic, I guess, but I think that there is a problem when we educate and talk to people like insurance is always has to be easy, simple, quick, 4 clicks. It's an important contract for avoiding risk in your life. I still think that people should have some sort of training in school, at school, at least some time in their upbringing around this. These are important contracts. Even if they are 4 clicks, they are important choices.
Dirk, you're nodding there enthusiastically at the idea of education.
Yes.
Tell us why.
I think that's absolutely critically important. We need to reach out to young people so that they understand this whole world of financial management. We're doing it with a variety of groups in the United States, but we must do more, because we live in a world where if you want something, you go to the internet, and 1 click, you have it. versus if you buy an insurance product, there's not a one click if it's for life insurance. You need to now provide biological samples. Well, what's that all about? I mean, that's foreign to what the millennials are thinking. And so we need to get to the point. We have some companies that believe they'll be able to provide the products that will not have to have, with regard to the underwriting, biological samples. I think that's a major step forward. I think it's critically important. I also think the millennials, as they then see their beloved parents, because it's interesting, the number one source of advisors to millennials are their parents. As they watch them age and then perhaps have to provide for them, they will realize we need to spread this, because unfortunately, mom or dad may be at a point to be placed into a home when son and daughter may be ready to go to college. And talk about the stress. No grandparent wants to be in competition with a grandchild. So again, this financial literacy, to begin having people think about it much sooner, will have great implications that'll be positive.
Am I allowed?
You can, of course.
Am I allowed an anecdote?
Please.
Over lunch today, I got a text message from my daughter saying, "My oven has stopped working. Will the insurance policy cover that?" And then I said, basic principle is sudden and accidental. And the answer, of course, was, well, it was accidental and sudden to me.
So, there we go.
It strikes me, actually, for younger people, they're well able to get onto an app to place a bet with one click and seem to understand how the odds work on particular bets very easily, but yet they won't get involved in something that they regard as boring, like insurance, until such time as they have to do so. But Dirk, you've raised an interesting point there when you talk about, things like DNA and biological samples or whatever. So are we moving to an era, perhaps, of even more individualized assessment of risk and quoting of insurance premiums, leading to a much greater range, perhaps, of pricing having to be done by insurance companies?
Yes, I think we are. I think we need to have new products designed. I think, let me say this, we talk about microinsurance, and we think of it for the developing countries. I believe that in many countries where you have a mature market in existence, you still need microinsurance, because we have so many members of the population, so many families that have not yet purchased into. You need a portal to get them started with regard to life insurance. They have the other insurance products. I mentioned in our program that if this hotel was notified that their insurance had lapsed last night, none of us would be sitting here. None of us would have flown if an airline had been told that their insurance had lapsed on the aircraft. Insurance provides for everything to be done. A point was made at one of the early morning panels that charity groups and others are reaching out to the insurance industry to say, you need to help us understand how to sustain growth because you know how to manage risk. More and more we're seeing from the G20 governments that they're reaching out. I see this in the Global Federation of Insurance Associations. The leaders from the G20 are saying, help us determine how we can shift some of these pensions and the liabilities that are on us so that the private sector will take them because you know how to spread the risk, so that you can have a private sector augmentation to the government safety net. And certainly for those people that want to be self-reliant instead of solely government-reliant, governments need to have a private sector partner to help them spread the risk.
Karel, something else I want to ask you about, because you mentioned at the start of your report back from your session, for those people who weren't at the session, you were talking about the difference between global north and global south, which strikes me as interesting given that insurance is very much dominated by major global multinational players. So what is the difference and why is it significant?
Well, I think that we had actually a presentation by a lady who is very knowledgeable about this, Andrea Keenan from the Micro Insurance Network, and she showed us a map of the world with different colors. It is really quite remarkable that parts of the world have no color. There is no insurance. There's parts of the world that have a 1% penetration. So the question is how you can move in these areas from the situation where they are to where they should be. And it was observed, for instance, that the only way to deal with that is have a diversity of products. Because in some of these markets, Craig from the World Bank, he pointed out that in some markets which are underdeveloped, that insurers are all fighting for the same product and competing to that, whilst there is a need for other products. There's a need for diversity. So there are really still markets in the world where insurance is badly needed. And even in developed markets, to move from a certain penetration rate to a higher penetration rate seems to be difficult.
You also mentioned having a strong local presence and local partners. Explain a little bit more how that can actually be achieved and the importance of it.
Well, that's part of a long-term strategy, and it was David Macmillan from Aviva who pointed out how he developed his live business in a country like Poland, where they were looking for local partners, and they have been operating there for some time, and developed a confidence in the market by not moving in, by getting to know the market and developing that slowly, making a long-term presence in that market.
But is that suitable for every company if you're, as you use the expression, playing the long game, staying and planning? But there are often demands from the shareholders or for the owners back in the host country as to what returns, what market share can be achieved quite quickly. How do you actually manage to find the correct balance?
That's a very good point, a very valid point. It was also made during the discussion. I've been wondering indeed whether for some of these companies it might not be better to have a mutual that does not have that strong pressure from shareholders. Because indeed, shareholders need a return on their capital investment. And that may be difficult. And that is a challenge when you move into markets where you need capital, that you actually have that capital, and are you prepared to make that investment?
Kirk, that's something you're very interested in, this whole issue of capital, aren't you, as well, particularly in this low interest rate environment of putting capital to work?
I'm sorry, putting what to work?
Capital to work.
Yes, absolutely. I think it's absolutely critically important. When we went to Turkey, and Mehmet, thank you for putting together the meetings, you and Karim, it was extremely helpful to have the government of Turkey that had the presidency of the G20 then. And they said, we didn't realize the extent, the relevance, what can be done with insurance. The fact that in the United States it's the #1 U.S. investor in corporate bonds. If that could be directed into long-term investments in infrastructure, it really helps people throughout the world. So the relevance of where you put your capital, and that it is working capital and not simply parked. That's why when we talk about over-regulation, you don't want over-capitalization. You want to put it to work.
Is that often forgotten now about the role of the insurance sector in stimulating economic growth and economic development and investment in infrastructure in particular, that there has been such an emphasis on making sure that there is sufficient capital available to pay on claims that it's forgotten about the other part of the role in economic activity?
Matt, I think it is, and it's a really good point that you raise, because the life insurance or the insurance industry in the United States is regulated by the states, 50 states. The Federal Reserve was not familiar with the life insurance industry. But then with the Dodd-Frank, we're now with the systemically important financial institutions, the Fed will begin being a regulator. When we began meeting with them, they said things like, we did not realize your industry was the #1 U.S. investor in corporate bonds. We did not realize that on average you hold them 17 years. We did not realize that every day for 365 days a year, you pay out in benefits $1.6 billion. It rivals almost Social Security. So people need to realize that. Matt, I can tell you that when they issued the Build America bonds in the United States, the industry bought 1/3 of them. But traditionally, they only hold 1% to 2% in the portfolio because rating agencies and others say, we think those types of investments are too risky. My goodness, if you could find a meeting of the minds with that magnificent source of capital that is long-term invested so you can guarantee for the well-being and dignity of people that have the products and also create jobs and correct the infrastructure, my goodness, what a relevant industry we are.
Well, Dirk has been telling us about the United States. How does that apply in Europe?
Well, let me first of all, I agree with that, but I want to put a proviso. Unfortunately, balance sheets have two sides, an asset and a liability side. And of course, it's nice to say the industry need to invest. Let's be careful. If politicians are going to ask insurance industry, now you all invest in infrastructure, and tomorrow in homes, and the day after tomorrow they invent something else, but you invest as a counterparty to your liabilities. If you don't have long-term liabilities, and that is the issue today. The issue today is that the interest rate environment is such today that it is very difficult for pension funds and insurers to offer long-term guarantees. But if you don't have long-term liabilities, it's difficult to have long-term investments. Because if you ask an insurer to invest in the long term and he has short-term liabilities, it's going to be an absolute mismatch. So there's a risk that happens. Now, you asked me about the European scene. In the European scene, as we heard this morning, there is more attention being paid to better calibrating the investments, the risk attached to certain investments, to have a more long-term focus. And I think that is the right direction. The problem, however, always is in regulation, is where is the middle ground? Because if we are overly protective, of course, we create problems with long-term investments, which is not right. But if we are overly uncritical about the risks, we might put the consumers into danger because there won't be enough capital if a problem occurs. So it's to find the right middle ground, which is very difficult.
Yeah, but Dirk, it's always about a balanced portfolio, isn't it?
It is. Of course, it's about a balanced portfolio, but I think it's fair to say that with Basel III and new requirements of that, there's a greater requirement with regard to liquidity for the banks, so that, again, many leaders throughout the world are saying the banks will not necessarily be that major source of infrastructure investment. We must look elsewhere. We would like them to look at this industry. One of the things I would add too, Matt, as we talk about this, and we talk about the U.S., et cetera, and local markets, but it is global. Even when we had some questions in my panel about what does this mean for someone who is not international, but in 9/11, when the terrorists hit the United States, New York, 60% of the money that was brought in to pay for the damage, 60% came from offshore, not from the United States. Yoshi, you know that with the tsunami, et cetera, I think in Japan it was something like 90%. In Christchurch in New Zealand, again, vast majority. So even though you think you are the local market, through insurance and reinsurance, you have a global network out there. And that's why, with Karel, it's important that we discuss these things because we're all integrated. Even though Solvency II will not work in the United States of America, it just will not work. But we applaud you for what you have done. So let's continue to find ways that we can find a continuation of this, because we don't want anyone within the industry to have a negative situation, because we all hurt from that.
Torbjörn, you wanted to come in there.
Yeah, I think, of course, there's a balance to be struck between risk-based capital and various types of long-term investments and the need for that in society. Infrastructure, maybe they're the most prime example. And we all feel that Solvency II took its time to implement, with due respect, Karel.
Well,
but I think we're going to see a very interesting experiences from Solvency II in 3 to 5 years, where we review the impact of on investments, and not least where we see whether the actual calibration is what we thought it would be, not only for infrastructure or securitization, but also for more basic investments.
I entirely agree with that. What is important when you do regulation? I mean, it took us time to develop Solvency II, but let's not change it now every 5 minutes, because we might take the wrong decisions. It doesn't mean we don't have to think about it, but let's think about it on the base of facts and not about theories.
In different parallel sessions, but I think there's a connection between Torbjörn, what you reported back, and Dirk, what you did. Torbjörn, I'll start with you because, well, Dirk mentioned longevity and the quality versus quantity of life. You talked about the connected body, which has a relevance for health insurance. As people live longer, and it creates different financial needs and different insurance needs. Just perhaps tell us a little bit more of what you anticipate from the future and what came from the panel session.
Technology is gripping into our lives in a way it is never done before. There are so many gadgets that come into our lives, homes, even bodies. And that'll create great opportunities for distribution, new affinity groups. That'll create new opportunities, maybe even for insurance cover, like cyber products. But of course, that will also, as we discussed in our panel, we will also meet challenges in lack of symmetry in information, as is being discussed already in the European Union, where first and foremost in the health insurance area, where people actually know, or life insurance, you know that with a relatively high degree of certainty you will have a health problem in 10, 20, 30 years of time, and you insure yourself against that without telling the insurance company about that information. I think that problem will become prominent in health and life insurance to a lesser degree in other types of insurance.
Dirk, what are your concerns in relation to greater longevity and the quantity against the quality of life enjoyed during that longer time span?
Matt, when I was working my way through college, I worked in hospitals. And I have attended to the elderly. I say that because I've seen the elderly when they are frail and they do not feel well. I've seen when you're wearing a gown that doesn't close in the back. There are going to be multitudes, millions of citizens throughout the world that will have achieved prominence and happiness and success. And then they will live longer than they thought. And they will live beyond their income. And then at that point when they are frail, and they're on an exam table, and they don't feel well, and no one remembers who they prominently were, try to convince someone how important you are. My concern is that the industry needs to continue its efforts so that everyone can have dignity their entire life, and that's where guarantees come in. One Nobel laureate has predicted that in many parts of the world, that those people who are 30 or younger today, half of them will live to be 100. 100. Actuarial charts just a few years ago went to, I think, 85. Now I think it's 120. A gerontologist has now said the first 150-year-old has been born. I said that to one group, and one gentleman said he's convinced it's his mother-in-law.
Just to conclude, though, does this mean that for the insurance industry, and Karel, if I could start with you, do you regard these as being problems or are they opportunities?
They're definitely opportunities. If you look at longevity, it's obvious that we cannot take care of longevity as we did in the past. Guarantees, however good they are, in a market with the interest rates that we have today, is virtually impossible. So we have to find alternatives. There are alternatives in the market. The alternatives, I've always said that you need 5 pillars for longevity. You need your social security, you need a pension, occupational pension fund, you need insurance, you need a house, and you need a family. I mean, all these 5 elements are absolutely crucial if you want to survive. Where's the opportunity? I think in Europe, I'm speaking particularly for Europe because I think the US is more advanced in that area of healthcare and long-term care. I think there's still a huge market in Europe to cover. And I would hope that the industry takes on that opportunity, because I fully agree with Dirk that if you end up to be old, but you are sick and you don't have the money to pay for whatever you have, then that's an absolute disaster. So we need to do something about that.
Torbjörn, to you, for customers and dealing with customers, does technology mean that there will be more opportunities than problems?
Customers will be widely different in the future, and there will be therefore a wide variety of demands on us as insurers, and I think it's an exciting prospect, even if it's a bit cumbersome.
And to finish with you, Dirk, optimistic or not?
I'm tremendously optimistic. I appreciated the Prime Minister of Ireland today talking about the young people of Ireland. They are motivated, they are creative, they are doing great things. I think that's true of our young people in all the countries that are represented in this room today. We must realize how to tap that. And I think part of our wisdom is to know that they have wisdom as well. They live in a different world than we do. And so we need to have that connectivity so that we can find the new ways to ensure that people can have a life where their families can be protected, but also they can have full expectation that if they are given the blessing of long life, it can be a blessed long life of dignity, and that they do not feel that they have become either a burden on their family or a burden on the government, because where's the self-respect in that? This is an industry about respect, and I'm just proud to be part of it.
And on that positive note, we'll finish this particular session. Thank you very much to Dirk, Torbjörn, and to Karel as well. Thank you very much.